Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, December 23rd. Coming to you on Thursday with the market closed for Christmas Eve tomorrow. Have the Santa Claus hat on and beating the drum for the Santa Claus Rally. What is the Santa Claus Rally? We hear about it often in the media. The Santa Claus Rally was coined by Yale Hirsch, the original publisher of Stock Trader's Almanac, way back in 1972. And what Mr. Hirsch had noticed statistically is the last 5 days of December, last 5 trading days of December, along with the first 2 trading days in January, delivered, statistically speaking, very solid performance, year in and year out. So that's when the Santa Claus Rally was coined in the Stock Trader's Almanac. It doesn't come to fruition every year, but there is a strong bid to the market, again, statistically. I have an article, a link below that you might enjoy. It's by Scott Bauer. Just gives some history of the Santa Claus Rally, something fun along for the holidays. In terms of the markets, where are we in the markets? Let's take a look at December. Led by defensives, right? We've spoken about that. Staples strong, healthcare strong, REIT strong, utilities strong. Multiple times the last 3 and 4 years, we've seen this. Each time growth is taken back over. Are we going to see that this time? Tough to say. Why? We have a couple of changes. Leo Chen likes to call them regime changes. For the first time, we have the Fed out talking about raising rates. Last time Powell talked about raising rates was going into the fourth quarter and through the fourth quarter of 18. Market really took it on the chin, a lot of volatility. So I'm thinking we may see a tick up in volatility in terms of Q1 and perhaps throughout 22. Keep in mind, 21, the pullbacks have been very tame. S&P has pulled back 5 or 6% twice. The Russell 2000's had a couple stiffer pullbacks, but the volatility has been tame. I think that changes heading into Q1. Market participants may be reallocating in terms of where they see Fed involvement. As the Fed tightens, different sectors may work. Be very important to keep our eye on allocations and to keep our eye on large, mid, and small cap. There are instances historically where in a rising rate environment, the asset class and equities, the cap size that worked best were small and mid. Let's keep an eye on that. In terms of interest rates, John will be on with a note. In terms of the 10-year, trading between that 140 and 150 area. It's been range bound. We'll keep an eye on that heading into January. Everybody have a Merry Christmas, Happy Holidays. Don't forget to like, comment, and subscribe, and turn on notifications so that you're always made aware when we have a new video coming out. Enjoy the holidays.
Hi everybody, it's John Mousseau. I'm the CEO and President of Cumberland Advisors. It is Thursday morning, December 23rd. Quiet week in the bond market with yields higher. The 10-year bond from a 140 to a 147, 30-year bond basically from 180 to 187, and certainly short-term yields higher as well. But the yield curve steepening a little bit this week with longer-term bond yields higher than shorter-term bond yields. What's more interesting is that with some of the consternation in the equity markets earlier in the week, with some down days and up days, it didn't matter whether it was a down day or up day, we saw yields rise. And that's something different than we've seen in the past few weeks. And I think it's a recognition of a couple of things. Number one, the Omicron virus, which has weighed heavily on everybody and is rapidly rocketing through the population, doesn't seem to be causing the amount of deaths and people in ICUs like previous variants. We've seen that in South Africa where cases really spiked high, but deaths in ICUs didn't. Hopefully here we have the same low level of deaths, we hope. That leads us to think that as it goes through, we'll somewhat get back to normalcy. One thing that hasn't changed, ongoing upward ticks in inflation. Today, we saw the core PCE, this is the Fed's preferred measure of inflation, rose 0.5% for last month. So it is now running year over year 4.7%. We know other measures of inflation are running much higher. CPI almost at 6.8. We know that producer prices index is running over 9 year over year. So the Fed has admitted they have a problem on their hands. They know that inflation is not transitory, at least in the view of many, except maybe Wall Street, which has kept rates low. But in any case, you know that they have started a double taper. In other words, start to draw back their purchases of mortgages and treasury securities. They will be done by March, and we think that they will also then start to raise short-term interest rates. If you look at what they call the dot plots of the Federal Reserve, it's looking like maybe 3 rate hikes next year off the bottom. Generally speaking, you tend to get some higher interest rates when that follows short-term rate hikes. So we think we're going to be heading to some normalcy next year. We know that if you settle in, as we've talked before, at a longer-term inflation rate, whether it's 4.5, 5.5, even 3.5, as some of the monthly numbers do start to come down on inflation, that with this longer-term run rate higher, how long does a 10-year bond sit at 1.5%? So we think that you start to see this migration upward. Muni yields, very docile this week, hardly any movement at all. And that's a reflection of the fact that there's really no deals coming, and it will be a very quiet week next week. So we don't expect much action there until we get into January, when bankers come back and issuance resumes. With that, we wish you all a very Merry Christmas and a very Happy New Year, and hope you've had the best of holiday seasons. Everybody, please stay safe out there. As we know, this is not over by a long shot on the coronavirus, and we want everyone to be safe, and we will talk to you soon. Thanks. Have a great holiday.